Welcome to another episode of Financial 15. Some great information. This was a topic that came up. We've had lots of questions on it. How to manage tax on your retirement income. Lots of great information. You definitely want to stick around.
Yeah, everyone's used to being at work, and you know that at the end of the day, you get a net amount. The government takes all the taxes and everything else, so does your employer beforehand. But when you're in retirement, it's a completely different thing, and we want to go over that. You may not realize how much you may have to pay or what's not being deducted. So today we want to do that, but you want to check this out, see this video or any others, please go to our YouTube channel and subscribe. Lots of great content there. You'll find a variety of different videos, or like us on Facebook. Most importantly, visit the website, beckerorr.com. Blogs, events, videos, you name it, we've got it out there for your financial well-being. But today, we are dealing with how to manage the taxes on your retirement income. As we've mentioned before, Clint, we get a lot of these questions, and we want to know what kind of taxes we're paying or not paying, and what should we do? How do you want to start us off?
Absolutely. I think you already did a great job with the intro there, mentioning that for most folks, you have a steady career, steady job, and that's the source of income, right? And they deduct the taxes at source. Maybe you have a bit of a side job or something in addition, but usually there's one main source of income, and it's all kind of handled for you so that you don't have to juggle the different pieces of that income puzzle. But that changes in retirement. Often in retirement, you get something that looks a little more like this. You have a couple of sources of income. You have a colorful chart here, but you could have the employer pension. Maybe it's a defined benefit plan, more likely a defined contribution plan, but some kind of work-related pension program. You'll get the government benefits, CPP, OAS, and then whatever you saved on your own in your RIFs and RSPs, TFSAs, all those accounts. And then you got to coordinate the withdrawals from there and make sure that the tax is ideally minimized, but you got to handle that tax burden as well. So it's a whole different ball game once you get into retirement. Isn't that right, Kevin?
Yeah, I mean, basically, you're right. I mean, I'm used to getting all my deductions done before I ever see my net pay. But I mean, I know a lot of retirees that we've dealt with beforehand where, you know, they're getting their OAS, they're getting their work pension, they're drawing money out of their RSP or RIF. They don't really realize whether taxes are there or not. They just see that net number and haven't thought about it. So these are things that you really have to consider. And it actually becomes more of a planning scenario here than it is when you're working.
It does. Yeah, it takes a little more effort in retirement often than it does when you're working. We'll go through them quickly here to give you an idea. So that orange square, or is that a rectangle? I'm going to call it a square. That orange,
yeah, the orange one's rectangle.
All right, rectangle it is. The orange rectangle and the government pensions, CPP, OAS. Important to note, taxes are not automatically deducted in CPP and OAS. So if you just apply, they'll give you the money. And then at tax time, they'll ask you for a big lump sum because they did not withhold anything throughout the year. So you have to ask them to withhold the tax throughout the year. Otherwise, the default is they won't deduct a thing from the CPP and OAS. And then that green rectangle, because we're agreeing it's a rectangle now, the employer pension. Often, if you get a pension or an amount from work, the default there is they'll assume that's your sole income. So if you have $20,000 a year from your work pension, they'll assume all you make is $20,000 and they'll tax you accordingly, which may not be enough. So you can have a burden there already just from those two. And then to make things really more complicated, to get into the personal savings, Kevin, and I'll let you run through this one. I'll pull it up for you here. There's a whole myriad of different accounts and different tax complications.
Once you get to your personal savings, then you're adding in just another ball of wax to go on, because we've already had two where they show that one doesn't take and the other one takes as though you're only earning the one. In your personal savings, if you're drawing out of your RSPs or RIFs, LIFs, PRIFs, whatever the case may be, of course, when you're taking the money out of that, if you're taking out of the RIF side, all you're taking out is the minimum. You don't have to have tax taken off, but you can. If you're taking out of an RSP, it's a progressive tax system depending on how much you take out of there. So there's only a source there. And again, it's only basing it on what you're taking out of that portion, not everything together. And that's a simple one because it's sort of just a base tracks 10, 20, 30%. But in your non-registered, now it gets really difficult. Interest income, dividends, capital gains, return of capital, a variety of different sources that are taxed at different rates depending on what you owe. Fully taxable, dividend tax credit, 50% inclusion. Those are all going to have a different source as to how much tax you're actually going to pay. And of course, the only freebie is the tax-free savings account. Anything you take out of there, you're good. You don't have to claim that to the government. You don't have to pay any taxes on it. But when you add this all together, you're looking at possibly 4 to 5 different sources, and each one is taxing themselves at a different percentage. So knowing what those numbers are is definitely going to be something you have to take a look at.
Yeah, and we're really getting at the idea here is the the tax you pay when the money is originally sent to you, whether it's CPP, your work pension, or one of these individual accounts, compared to the tax you actually owe, which could be due at the end of the year. And those two could be different, right? When you're working, often if your sole income is from one employer, well, those are going to be the same amount. The tax they withhold is probably the tax you owe for the year, so you don't really have to worry about it. There can definitely be a separation in retirement because all of these have different tax consequences when you draw it out, but how it's added up to your total income could mean you end up with a different tax bill at year end. So we're going to go through an example to really get kind of hopefully have that point sink home. We'll start in our example at $60,000 as total income. So not just from RSP or not just from pension, add it all up, $60,000 total in our example. And then this is all the different tax brackets for a $60,000 income, wherever you are in Canada, whatever territory or province you live in. You can see if I had $60,000 in Alberta, our marginal tax rate is 22.18%. If I'm in Ontario, it's 26.97%. We're going to use Manitoba in our example. I just wanted to put that up there so you could find your number and you can plug it into our example so you can still have some relevant data there. But I'll let you set this up, Kevin. Our example, $60,000 of total income in Manitoba. Introduce us to Mary here.
Yeah, so Mary is a retiree, and she retired the beginning of this year in Manitoba. Now, for the sake of clarity, we are going to use the work pension source. We're going to use the government pension source with CPP and OAS, and we're going to use the retirement source for RSP. We could include non-registered, but now, again, as we mentioned beforehand, interest, dividend, capital gain, there could be a variety of different things to add in. So to keep this more simplified, we're just going to use the three sources. $2,000 work pension, $1,500 a month from CPP and OAS, and $1,500 a month from your RSP. So Mary, if she does not adjust her tax on any withdrawal, each one of these is going to tax her differently if they tax her at all. And that's where we have to take a look at what does it look like. As we see, the work pension gives us a withholding tax of 15% because they're assuming that's all that she has for the year. It's not counting any of the other two scenarios. And for CPP and OAS, as Clint mentioned right off the hop, there is no tax taken off unless you've requested. Our example, she didn't request, she's going to get the full amount. And the minimum withholding tax on the RRSP or the RIF that we're taking out is going to be 10% because it's under that 5,000 limit. So $1,500 off the first month, they're just going to take the 10% from there. So that's set the whole thing up. Clint, what are we going to look at when it really shows? How much tax is Mary actually paying a year?
Yeah, and that's the idea. You might think, oh, they're withholding the tax at source. I'm good. My bill's been paid. And then you come to year end, you'd get an ugly surprise. So during the year, you can see the table there, the different sources, how they add up, the tax that was paid as she went through. So on 60 grand, she only paid $5,400 of tax. That'd be great if that was all the tax that was owed. But unfortunately, like I mentioned earlier, we showed you the table and all the different numbers. You actually go to tax time, and this is a simplistic example, but it shows you the tax bill is much higher. And Mary here would get an ugly surprise where she'd have to pay an extra $7,800 in tax. Now, maybe there's tax credits and other deductions. We didn't go through a whole tax return here. We just zoomed in on the different sources of income. We did use the Ernst & Young tax calculators. That's a good tool, by the way. You can see it on the bottom of the slide, the eytaxcalculators.com. So if you don't know about that, certainly add that to your list of tools. But you can see here the big gap, right? If Mary did not adjust what she was doing, she would have to be saving money to pay a big tax bill every single time she filed her tax return. Sometimes people are okay with that. They just plan for it. They know the bill's coming. They put some money aside. It's a non-event. I'd say most people, that's not the case, Kevin. I think most probably want to pay as they go, and that way they don't have to worry about a big lump sum payment come tax time. And if that's the case, you can see here, if you adjusted the numbers, you went to CPPOS and you know what, take 20% off of that. The RSPs, instead of doing the minimum, you said, you know what, take 20% off of that every month as well. Well, suddenly you're essentially paying what you have to by the end of the year, and you avoid that big lump sum bill, right? And we kept it simple here, but that whole concept, if you got to manage the different sources and coordinate it to make sure you understand the tax you owe and the tax you actually pay throughout the year and can be prepared for it.
Yeah, exactly. And I mean, you've got to make sure that this is something that you take a look at, because again, as you mentioned, I don't think most people plan for this. So, you know, if you've taken money out of your RIF or your RSP, I mean, the work pension only pays a certain amount and CPP and OAS aren't there. If you get that big tax bill at the end, all of a sudden you're drawing money out of a source that maybe you hadn't planned for. And now you're taking more money out. You may have to pay more tax to cover what your taxes were the year before. These are all sort of big scenarios that we have to deal with. And of course, that leads always to the Becker Orr fabulous mantra. What should you do? Have a plan. This is the big thing, whether you discuss it with your financial advisor, talking to your accountant beforehand, anybody involved in this, and make sure that you know what's going on. Because again, like I say, if you're starting to draw and this is your plan and you didn't realize that you had to pay the taxes, your plan may skew a little bit if you have to owe that extra $8,000 this year. And then of course you're planning for it next year. Well, now you're getting a little bit less than what you were getting for beforehand for your net income. These are all things that could really screw up things going forward, especially if it's done early and it's not caught. So again, have that plan as a big factor and make sure that you've discussed it or taken a look at what the options are.
Absolutely. Absolutely. And the idea that the plan's carved in stone, you have every penny sorted in advance, probably not going to happen, but you have a pretty good idea. And then you live retirement for a year or two, you'll be able to fine tune it. And then it's no longer a worry. You got the system set up, you get your income, and you got the taxes sorted as well. But like you mentioned, you got to put some effort in there to make sure the plan is in place to manage that. And of course, if you have more questions on your plan or anything else in the financial world, let us know. We're always happy to chat with you. Chat with ClintonandKevin.com, part of our website. You go there, fill in the form. We'd absolutely love to hear from you. Any parting comments for the folks, Kevin?
I make this real simple today. No. We've covered everything.
We'll end on that note, a one-word ending. Take care, everyone.